Most traders get stopped out, not because their idea was wrong, but because their stop loss was. That is the difference between a beginner and a trader who understands market structure. I'm going to show you exactly how that looks like using two real examples. Right now, we're looking at gold. Look at this first trade. The setup isn't bad. Price short term is bullish, momentum is shifting upward, and the take profit is placed at the previous highs where buy-side liquidity sits. Solid reasoning, but the stop loss right below the most recent wick. And that's where the trade dies. Here's what most beginners don't understand. Markets do not move in a straight line. Price pulls back, it sweeps highs and lows. It hunts liquidity before continuing in its intended direction. That's not manipulation, that's just how markets work. So what happens? Price dips slightly, sweeps the liquidity below the entry, triggers the stop loss, and then moves exactly where the trader predicted it to go. Directionally correct, but structurally wrong. And that distinction costs beginners an enormous amount of money. The core issue is emotional placement. Traders put their stops where they feel comfortable, and not where the setup actually becomes invalid. And because retail stop losses cluster in the same predictable spots, price routinely reaches down to grab the liquidity before reversing, in ICT and SMC. This isn't a surprise. It is expected. Now let's take a look at the second setup. Same target, the previous highs where the liquidity rests above the market. But the stop loss is placed below the actual swing low, beyond the sell side liquidity zone. This changes everything. The trade now has room to breathe through normal price fluctuation. And more importantly, if price actually breaks below that level with conviction, the bullish thesis is genuinely invalid. The stop loss is doing its job. It marks the point where the idea no longer makes sense. That's the standard your stop placement should be held to, not how much am I willing to lose. But at what price is my trade idea simply wrong? Targeting previous highs isn't arbitrary. Those levels hold resting liquidity, stop losses from prior longs, breakout orders from trend traders. In ICT and SMC, price moves from one liquidity pool to the next. Identifying those pools gives your take profit a structural reason to exist. A lot of traders go chasing 1:10 and 1:20 setups with razor-thin stops. They've seen it done online and so they imitate because they want the same. But the reality is they get wicked out on normal market movement, then watch price travel exactly where they called it, without them in the trade. A slightly wider stop with proper structural placement will outperform a tight stop with no logical basis every time. And if your stop needs to be wider, the answer isn't to skip the trade, it's to reduce your lot size. That's how risk management actually works. The stop placement is dictated by structure, and position size is what controls your risk. So, place your stop beyond liquidity, beyond the level that genuinely invalidates your setup. Place your take profit at the next logical liquidity pool that the market is drawn toward. And of course, size your position accordingly. This is not a beginner approach to trading. This is a structural one. And if you want to stop getting stopped out at winning trades, is the only approach worth taking. If you found this breakdown useful, please consider leaving a like and subscribe for more content like this. Thank you for watching. I'll see you in the next one.